Good morning, everybody. Welcome back to the Schwab YouTube coaching channel we call Trader Talks, or Trader Talk in today's market on a Thursday morning. I'm your host, Kevin Horner. Thanks for being here, everybody. We, of course, are going to take a look at what is moving around the market this morning here, get a lay of the land as it relates to the broad indices, and take a look at how things are developing there in the barrel price, because it seems as though we continue to be very tied to the movement in oil. So we'll talk some headlines today. We'll look at some charts with all of you. This morning, I am pleased to be joined by my friend and colleague, Barb Armstrong, in chat. Please say hey to Barb. She, of course, will get to comments, questions that I'm unable to address. As always, you know I'll keep an eye on things there. If you're not already doing so, please follow Barb and me on X, Kevin Horner, CS, Barb Armstrong, CS. We'd love to have your follow on X. We try to post for you there throughout the week some interesting topics. You're going to get a bunch of charts from me. So if you're looking for that kind of thing, appreciate the follow there, in addition to, of course, following us and being a subscriber on the YouTube channel here. Now, one heads up for all of you. Yes, I am without camera this morning, working through my local internet provider issues. We are making a change there. I fully expect things to be substantially improved by early next week. So I appreciate your patience with me, everybody. Let's go ahead, get to our disclosures, and then we'll start looking at the charts with all of you. So first of all, please remember that everything we do today should be considered informational and educational exclusively. We do not make recommendations here, nor any endorsement for a specific approach to trading the market. We will incorporate and utilize technical analysis, though, as we review the areas of the market with you this morning. Remember to think of technical analysis, though, as just one piece of your decision-making puzzle, not the entirety of it. We encourage you to utilize multiple factors when basing your trade decisions, of course, and would discourage you from using only technical analysis to make those decisions. And if you are new, this is our standard agenda, everybody. We do start with our broadest of indices, the S&P 500, the NASDAQ 100, the Russell 2000. We'll check out the yields on the 10-year note, some changes there of late as yields elevate. And then we work our way through industry groups like your transports, your semiconductors, maybe some of the industry groups within industry groups, otherwise known as sub-industry groups, and sectors, of course. So in the latter portion, we may have some stocks in the news to take a look at. We had some big ones yesterday. We'll get a couple of upgrade charts today and a couple of downgrades as well. So let's finally remind you that we are pretty active on the travel schedule these days. This weekend, the in-person event team is here locally in Denver. I'm looking forward to being there just this afternoon. As it turns out, we'll get everything set up today, have you out there on Friday and Saturday. Same on the Dallas event. Turns out I will be going to Dallas after all, so I look forward to seeing those of you who will be in the Dallas event for the advanced options there in mid-April, and then Boston at the end, or rather the middle of April as well. I guess that's 17th, 18th. So if you are in one of these areas, are looking to attend, check us out at schwab.com/events, everybody. Now, let's get to that chart of the S&P. We have talked a lot about that 200-day moving average this last week, haven't we? And we've also talked about the need to, to maybe bring this into a more tighter time frame to evaluate what it is we are seeing from the S&P 500. So a couple of things on the daily chart that we've been watching are these notable tails, boom, boom, and boom, all three of them right into the 200-day moving average, all three of them at rejection levels, right? So we clearly see that on the daily chart, what we take away is a lack of bulls' capability to get through the 200 with any conviction. So we're into the 200-day on an intraday basis, and yet on an overnight basis, we just can't maintain, or on a closing basis can't maintain. So that is not a great setup for us. Now, if we take off, look of the daily chart and kind of pop back to a more broad look of things on the intra-period, we have been monitoring this pretty aggressive downsloping trend line. Now, whether you choose to do this with, standard moving averages, this is a 52, but ultimately we've been really tracking lower, making lower highs since, for a while, as it turns out, but most recently, since late February, right? So if we started from this peak and just drew our downtrend line, we can see our rejection area. We rally into the trend line, maybe the moving average, but it's been sold each time we rally into it. And this is, as a trend goes, this is, downtrend pretty evident. And the reminder on a downtrend situation, everybody, is that it's not a downtrend situation, it's a trend situation. Once you've got the trend developed, the trend is more likely to continue than to break. Therefore, traders should take an approach that says, show me the trend has broken so that I can believe that the trend is broken. So basically forcing the instrument we're working with to make the move, and that validates the shift, right? So this is fairly clear downward channel. Now, the risk that we're witnessing this morning from a trend standpoint is that we've basically moved the trend, the very short-term bounce trend line we'd had. See, so, I'm going to draw a bunch of lines in, and the truth is, yes, you can draw as many lines as you want. That doesn't mean they're necessarily valid lines, but what stands out to me, I guess, is this most recent bounce did nothing to change our downtrend. And I take that to, if you look at the line I'm drawing here, this becomes a red line for me because it's a resistance level, about 66.40. It kind of put it in at 66.38, but really it's, 66.40 and beyond or so. And so you can see support, and then resistance, and lower. Okay. Now, is this tied to the lack of development in peace talks? Yes, absolutely. It's very safe to suggest that what we're witnessing here is tied to that exclusively. The headline risk is substantial, and yet we can't deny the fact that prices are moving to the downside. So yes, you can say, oh, well, it's just because the headlines are negative. The truth is, the technical side of things, as always, I'll remind you, technical analysis suggests for us that everything that is known, both truth, rumor, conjecture, etc., that is what is known about the market at all times, whether we're talking this S&P 500 or your individual equities. And so price action, regardless of the headline, is defined as we know everything, price knows everything, we're taking everything into account. Okay? That's the reminder. And so, yeah, a little bit of a risk off today because we've now broken the very brief uptrend we've been witnessing off of the low we created from Friday into Monday. Okay? So flipping us back to our daily, we don't like our setup here, and we're going to need some semblance of short term, a news note, a headline, a validation on peace talks, anything that maybe it could be just the same comment from both sides on the peace talks could be sufficient to get our market in gear here, but it's not happening right now. So heads up. I've been talking about, I hope you've been listening, been talking about properly positioning ourselves for the risk of bigger moves to the downside. The level under this, I think, let me see if I've got a drawing set. I've got my weekly. Okay. So the level under this, everybody, we talked about this level. Let me, draw a line here, and then I'll just give you these, and then we'll move on to the NDX. This level here, and then, so right around that, and then 6,200 becomes another area or monitor, okay? So that's what we're looking at in the near run here, everybody, in terms of the potential for hold up. Can we maintain these lows? Hopefully so, around 65. If not, 6,200 becomes in play on the chart. Now, it doesn't mean it gets there immediately, of course, as you all know, but it does mean we might be just witnessing the same thing we've been witnessing, which is the riding of the 20-day moving average as resistance. It's got a pretty good downward slope for us. A couple of things. First of all, Barbara, only war, or are there other considerations bringing the market down? You absolutely can ask that question. Fitting for sure. No, it is not just war. In fact, while positivity on the front of the war could benefit us, it's not to suggest that everything is fine from there on. One of the things that I'm going to, we're answering a question. Let's go to it. Let's go to our dig in a little bit here, everybody. I've got access to economic data, as do you, in our Thinkorswim desktop application. And we'll go to my home link here. One of the things we can look at is mortgage rates. I don't know if you all knew this, but our rates are available here. So let me take a look at, I'm just going to type it into the search engine here, make this a little easier. All right. So the 30-year mortgage, for example, has bounced. Let's change my range to just the last 5 years. And this is what wasn't that long ago. We were feeling really good as we got the mortgage, this 30-year mortgage under 6%. And then all of a sudden here with recent detail we've received in the way of economic reports, PPI has been hotter. We've got elevated inflation as a result of elevated oil. This is a development we don't need to see. We continue to get indications of a very difficult housing market where sellers are well in excess of buyers. We are in a spot where valuations on homes are apt to drop just to bring buyers back to the market. And if yields continue to climb, that is going to continue to put strain on your sellers of homes. They cannot continue to maintain the levels they would like in terms of value in order to sell their home. They're going to have to drop prices just to be sellers. And at some point, as always, there is a crux, right? A spot where the buyers and the sellers, well, the buyers don't need to make a shift just yet. They probably don't have an opportunity to shift to willingness to pay higher prices or deal with higher rates. It's the seller who's going to have their own, realization that they need to make a shift. And that's going to change the market at some point. But we have not reached that point yet because in the history, if I'm not mistaken, I think I read that what we've seen of late is that the sellers exceed buyers by the greatest discrepancy in, if not history, in an exceedingly long period of time. So that is another concerning situation, as is the risk of jobs being eliminated, that are jobs that may never return to the general marketplace, if you will, right? Due to the development of AI, for example, we have lots of fear that the job market is not exactly in as good a spot as we need it to be. And further, if that's the case, well, how do we get those jobs back to the people who need them, right? Chances are a lot of those companies are moving on from human resources, right, as an outlay of cost, right? They're trying to reduce human resource costs at this point. So we do have, the answer to your question is we have more risks than the war. And so I didn't want to just say, yes, we have more risk than the war. I wanted to make sure I offered up something beyond that. So I hope that's helpful in that regard. So, yeah, I can always count on you guys to make me laugh a little bit in the chat. Thank you. Okay. Let's go ahead and move to our NASDAQ 100 here. trend analysis on the NASDAQ is very much similar, very much in line with the SPX. We've been watching the 50-day a little bit more. Notice the level we're dancing on as we speak, same lows that we made back here in November. This is a very important level of horizontal support, everyone. And again, given the window of time beneath the 50-day moving average, if you're trading this market, everybody, and no one would just want to dissuade you from taking opportunity, but be thoughtful about why you're putting money to work here. Are you buying at these levels because you think a relief bounce can occur? And if so, what is the target? Remember, a relief bounce should be viewed differently than I'm buying at this spot with the intent of holding for the next 3 to 5 years. That's a very different approach, right? If you decided to step in here, as an example, believing we could rally into the last highs we made, but still below our 50-day moving average, maybe a trader kind of looks at it like this and says, okay, as long as we can make this move, I'll take a 4% rally into resistance. Well, if that's the case, make sure you're looking to exit as you rally into resistance. Stick to the plan you develop for yourself. There is absolutely overhanging resistance here with the moving average. That 50-day is pretty obvious. So we've been below it since February 3. Now we're looking at almost 2 full months below it when we get to early next week. So remember, new trend, new risk, potential for this to continue. This could be a zone for supportive purchases, but it doesn't mean buyers here believe that we're going to new highs from this spot, right? So there is still risk. Know where you would move on, know where you would reduce your position size, which would give you greater comfort maybe to stick with what you've got. But this level we're dancing on as we speak, very important. If we were going to look down to another level of support here after on the daily chart, I might just do something like this. So you've got this elevated range, this kind of double top. The difference between these two stands out to me. So let's just apply the difference between these two to this line and suggest that potentially a measured move for a break of what is support currently, I'm going to color that green here because it is still holding up. If we broke to the downside, everybody, could be in the ballpark of this. So this would be the potential for a measured move, and notice where that lines up, right with, at one point, a level of support here. So that should give us something to consider. Again, my encouragement for all of us as traders is to suggest where support resides, support 1, maybe the green line, but then always say, I could be wrong about it holding up here. I'm not alone in thinking it can hold up here, but what if we are collectively wrong? Where is another layer of potential support? And further, if it got there, what would I be doing? What steps would I take in my trade process and plan? Because the truth is, look, if we got down there, everybody, that's only a 17.5%. That's not even the 20 standardized 20% drawdown, right? So for many of you, you'll even look at the white line here at 21,560 and say, yeah, that might be good, Kev, but it could easily go lower. And you would be correct. It could easily go lower. Always be thoughtful about whether it could, if I'm wrong, if it could go lower, what's the next layer? Okay. Always important to give consideration to that. All right, let's look at our small caps. Small caps off 0.5%, 10-year yield rising. So kind of a same discussion we've been having here with the small caps, unfortunately. So let me put up my moving averages. There's your 20, your 50, your 200. We are into the 20 here, everybody, but we have not done anything to break this downtrend just yet. So, could we say that something positive has developed with the action of the last 2 days? Yeah, we could. because we could draw this line through here where we've been rejected, and then finally popped. But the fact that to this point, our pop was met at the resisting 20-day moving average, did not make a higher high right through here, which would be necessary, okay? All of this stands out as, hey, not as ideal, not what we're looking for in the way of small caps. And take a look at the 10-year. Elevated, staying above the 4.3 level, which we talked about just this week. We need to get this back below 4.3 to have a little bit of a tailwind behind the small caps to lift us up collectively. It's not really doing so right now, and we're battling it at the moment with everything, with higher yields, higher inflation numbers, higher oil, all of that coming home to roost, so to speak, right? Risk factors continuing to permeate the market. Now, if I can give you one anecdotal comment additionally, it's that we are digesting every bit of news. This is what happens in drawdowns in the marketplace. The reminder is that when every headline is negative, you can't really get great positive moves from the broad market, can you? It's difficult to digest them positively when all the news feels negative. So with this in mind, the elevation, which we'll look at our VIX here in a second, but the elevated VIX, the volatility of the broad market, all of it should be reasons for us traders to be more disciplined with our process. And for many of us, when I say more disciplined, all I'm referencing is an unwillingness to be as risk confident as you may have been in the prior few years. This is not at current time a risk on market. You've got plenty of signals detailing just that. When we look at the SOX, the semiconductors here, I'm going to put the 50-day as the lone moving average on. You'll see below the 50-day moving average and basically the entire month, everybody, all month of March, we've been below the 50-day. And while we have tried to get through it here, we have not. Instances of busting into my red line have been very limited in scope. And when you get there, what's occurred? We've been pushed back, right? So at least until we get beyond this moving average, the 50-day moving average, with any conviction, it's going to be tough sledding. All right, Pablo, I see what you're saying. Yes, I do mean take less risk. What I ultimately mean is be more in line with your tolerance for risk, but my hope is your tolerance for risk is tightening as the market is giving you reason to do so. Ultimately, many traders get bogged down in trying to stay the course. They continue to trade groups that aren't working, groups that have been telling them it's not working. We're trying to, our encouragement is, of course, as traders, to go where the trend is favorable. There are areas of the market that are in bullish trends, and it would make more sense to consider something like that than the difficult market, or at least until the difficult spaces get into better scenarios. And yes, when I say take less risk, I do mean it. Make smaller trades, right? Put yourself in smaller positions if you feel the need to take risk. James's comment about sticking with the trend, basically, right? If the trend is not bullish, don't enter bullish trades. That makes sense. But many traders don't take that approach. They need to be trading. They need to be involved in the market. My hope is that we are not reinforcing those bad habits, but reinforcing the good ones. And some days, everyone, it's as simple as stepping away so we don't make a new trade that doesn't make any sense. Semiconductors, we're in a bit of a rough spot. We haven't broken down officially, but we definitely have this rising wedge into resistance. By definition, it's a bit of a bearish pattern. If we looked at it on my hourly chart, as I've just shifted us to, you can see the areas where we've been rejected, right? They've been pretty clear here. So if we can trade through these levels here, these two ovals, we've got a shot to fix the trend. What if we traded under the short-term uptrend line in white? That would be a bearish development for us, right? So know the levels where you would make a shift or a change to your viewpoint. That's really the key to this. And yeah, I completely agree, Barb, as much as I hate to say it. Hey, I think that sometimes the best trade is the one you don't make. Unfortunately, I love to trade, so I'm in a similar situation as many of you. Sitting on my hands becomes difficult, and I am constantly speaking to the voice in my head that says, oh, you need to do something here, and I'm saying, no, I don't. I'm comfortable not taking position. I'm hopeful some of us are taking a similar approach as it relates to your own comfort. So we know what needs to happen here in semis, and we also know what's going on in the transports is tied almost exclusively to the upward momentum in oil. It's been very difficult on the transports. Transports have held an area of support. We have the 50-day overhanging us. For some traders, though, it might not even be the 50-day they're watching. Maybe they think we can get through the 50-day and they're watching the top of the gap. That could be the resistance band. So we'll just leave that line in there as well. Don't forget to check your components within the transport. So we'll go into, how about the planes first, DWC, AIR. So here you go. Your planes have come off of a zone of support, but we are probably right into the 20-day moving average, I would bet. Sure enough, we're below the 20, we're below the 50. Let's clear those lines out. Boy, the technician in me can't help but just say that looks a little bear flaggish, doesn't it, everybody? My goodness. So that is not ideal for the airline stocks here. Keep a close eye on this. Back above the 200-day would be what you're looking for bullishly, right? Because check this out. If we did this as a bear flag developing pattern and it broke down, everyone, well, the measured move potential target is down in the neighborhood of 1,600. That's crazy, but that doesn't mean it can't happen. Okay, that's a 28% move, according to my line at least. That does not look good. Doesn't mean it can't hold. Doesn't mean it has to sell down that level, but that's what the measured move calculation would be. Remember that measured moves are never a guarantee to be achieved. That is just how a technician might draw that detail in there. Let's see. Okay, hit up those rail stocks for you all. Okay, so rail holding the channel still. Didn't get to the 200-day, but you got a little confluence down there. So some traders might like the look of that. So far, we've basically maintained the channel. Our window outside of the channel was short-lived. So basically got thrown all the way back to the bottom of it. But, you know, if nothing else, it could be said that we know where things would change on the rails collectively here, right? A lot of traders would choose to reduce position under the 200-day, given what we've seen from this pattern that's developed. Moves above the 200-day have been your supportive ones. So, and I should point out, that there is a bearish divergence. We always talk about bullish divergences, but notice that the RSI here made a much lower low. We got into oversold conditions down there, even though the price here is much better than the price was at the beginning of the year. So here's what I'm getting at. We had this as our low, and look at where the RSI is here. But here, our price was much higher, and the RSI was much lower. That's not ideal, okay? And then lastly, on the transports, let's look at the truckers. Also in a bit of a pinch on the oil move, and got to call that out, everybody. The 20 and 50 confluence right here is notable. Oops. Because what we're getting here is traders of two different windows of time, seeing their moving average of note come into play together. that is not great. So this is acting as a potential resistance spot. If we can get the truckers over that ledge, then we start feeling better. But also, this resembles that same bear flag situation we talked about collectively in transport. So, all right, less than ideal across the board. I wanted to make sure I highlighted for you all the chart that we've been discussing here frequently this week, which is oil, the VIX, and the S&P together. So I'm going to bring that chart up. I'll remind you that we are using the futures symbols on these. These are not designed as a recommendation for you to use futures, of course, but it is just simply to track the relationship in trend. Notice how last night we had this bit of a rectangle development, a little sideways here in oil, and then we got to the upside in oil late in the afternoon, and we've run it to the upside, got all the way up to about 95. And in so doing, notice the same thing. Whoops, wrong draw tool there, Kev. Same thing at the same time in the S&P, only it was at the elevated level. So when we had oil break out, we got the S&P to break down and the VIX to break up, right? So we've climbed. Now we've managed to see the VIX kind of lose steam at around 25.5 today, but ultimately we need to see oil pushed back. And I think the level for us kind of in a narrative, a story, if you will, back under 90 is where I think S&P bulls, general U.S. market bulls are going to feel a little bit better. The barrel over 93, 4, 5, it's too close to $100 a barrel. Certainly a level we need to keep an eye on. $100 a barrel, very important psychological level, but keeping an eye on the relationship between these three can maybe at least help you validate your intraday price action throughout the day. Okay, so there's that look. And then if we wanted, here's a look visually at our relative strength on the sectors of the market. Now, our friend Rachel Deshelle built this chart for us, brought it to us in Trader Talk, more than a few months ago, but it's a real helpful way to basically visualize what we already know. You all know that I rely on the quotes page of our Market Watch tab. We'll go there momentarily, but also this is just a nice way to see it visually. So we've got energy clearly providing leadership for us. It's been our strongest on a year-to-date basis. We all know it's better than 30% year-to-date. And you can see the ones that have really kind of led things. So you've got a nice uptrend in energy. You've got an uptrend relative strength even in staples here. We've done well with materials. Materials kind of turning a corner here recently. We'll look at some of these individual charts. Remember, these are not the charts of these groups. These are defining the relative strength of these groups versus the S&P 500. So technology really lagging the S&P here of late. Same with discretionary, same with financials. So let's go ahead and hit up some of these charts for you, everybody. Let's just kind of work our way through it. You can see the brief breather we're getting in oil, in energy. I didn't mean to say oil. Had a huge two candle day rally, and then just sideways here. So not ugly by any stretch. That is essentially consolidation, right, or pause. I can share that script with you all. Let me bring that chart back just real quick. Share this grid. Again, this is Rachel's grids. I don't want to assume that I built it, but nonetheless, remember that any grid like this that we share, these are not guaranteed for your timing nor your accuracy. Just a heads up. So energy, bullish 20-day moving average for many traders, sideways up here after making a new high. RSI confirming the uptrend. Materials getting that bounce, but right into the 20-day, still a lower high. Let's be a little bit cautious at the 20-day. It's a spot where traders could maybe take some off, where traders would say, hey, this is still a downtrend. We need to probably make higher highs before we feel more confident. And that probably means something like so. Got to get through and make a higher high, and that's going to be in this vicinity. So watching that. Industrials holding up, but we still have the cross. So maybe we're still due for a little bit more chop in here, everybody, on industrials. A lot of these moving average crossovers are going to be witnessed, and we're going to see that we need to get some price bounces before we can really start getting more comfortable. I'm going to take this line. I'm going to put it down at the last low because that seems to be where we held up. Our hope, of course, is that that's a good low and that we can get off of it. But we remain below the 20-day here in discretionary, continues to struggle. And we have the 50, crossing the 200 to the downside. Not too fantastic. So heads up on that one. What about staples? Staples could be said to be at an area of support. Yes, we've got the 20 and 50 crossing each other here. So that is not great. We do have the 20-day aggressively downward sloping, so any relief bounce could certainly find itself losing steam at the gap here. It might be by that time coincident with the 20-day. We'll have to see how that plays out, but the reminder was it's made a fantastic move to the upside, 18% from early January to the peak here in mid-February, and then sold off to our breakout zone. So let's hope that we've got a good support ledge in here, if nothing else. Now, healthcare found the 200-day, found 50% retracement, and has held in. So could that be a spot for it? Sure. First real test of the 200-day since we broke it back in October. So an improving development potentially, but still overhanging short-term moving averages. Pay attention to these. Our financials have been in real struggle, continue to fail at the 20-day moving average. You'll see that if I were to zoom in there, look at those four tests of this ledge. I think resistance is pretty well defined here on the financials. And again, the reminder is, hey, if we get through this level, we might be able to pop higher. Terrific. But don't forget to believe in the existing trend. We are still in a downtrend. Any break of resistance, while it could lead to some optimistic move to the upside, it does not mean a reversal of the trend. It may just mean a short-term bounce into resistance. Here's the look at technology. The only positive we can really take from the tech chart, unfortunately, is the bullish divergence we have in the RSI with the new lows we've made over the last week, but the RSI looking stronger. So that at least gives us the view that potentially something could be developing with technology, just not yet. Communications below the 200-day for the first time in a while. We got to go all the way back to April of last year when we caught it, and we're below it and hoping that today's low is our bounce zone, everybody. So horizontally, could we be considered in some semblance of support? Sure. There's a gap level beneath us here that we might need to monitor. But today's candle so far looks good because it was a terribly weak open that was led higher by the bulls. Let's see. This is more or less kind of confirmatory of a downtrend as the RSI moves to new lows at the same time as price moves to new lows, or new short-term lows, at least relative to the last one. So heads up there. Let's see. Utilities are up a little bit. Now that's interesting with yields staying elevated. So I thought maybe we would see utilities dropping further, and they definitely made a significant pullback after the yields popped. But just a maybe heads up, we are holding the 50-day moving average in utilities here at the moment. So maybe keeping an eye on that. And then finally, in real estate, again, as we continue to look at higher rates, traders might not be as comfortable taking traditional market risk. And what do I mean by that? Well, just remember what traders tend to do when we have the so-called risk-free rate of return on for example, a 10-year treasury note at a level of 4.36. That tells us you can go get a risk-free rate at 4.3 for 10 years. Not every trader is going to want to go buy REITs or utility stocks that might offer 3 or 4 or 5% returns from interest and or dividends income, but also have market risk, right? That market risk is the key factor for so many traders. So, in the eyes of an individual less likely and less comfortable with risk, why would they buy utilities or REITs which carry that market risk to get a solid rate of return when you can go get it at 4.3%, which is pretty darn solid, broadly speaking. Okay. Say, I think you're asking about my My Tools bar up above. I think that's what you're referencing. We've been going through a little bit of a struggle with the My Tools. There's a bit of a glitch after the most recent update to the platform, but ultimately it's this here. I hit the gear, stay on the General tab, My Tools down below. I've got it designated on each chart. You can also put it as a single panel, which means that it opens as a separate box, a separate tool. Don't forget, though, once you've built it in and put it there, I pinned it to the top, hit the gear, and this is where you add your buttons. So anytime you add a button, you can add anything. Do you want it to be a draw tool? Do you want it to be one of the all of the studies available? Or maybe it's one of your own study sets, which are what I'm using there, everyone. You can also do time frames here. So if you are the trader who makes quick jumps, changes to your time frame, you could also consider that. Okay, and we are just about at time, everybody, but I promised I would get to a couple of stocks in the news. I wanted to show you the ARM position. So ARM Holdings yesterday had reported earnings and, I apologize. ARM was upgraded today at Needham to buy. That is buy from hold. They put it as a $200 price target. A company's high stake bets, including raising their royalty rates, going into subsystem, making their own silicone. These are working according to the analysts. And ARM Holdings has become a credible AI play right around the time when the company has better structured itself to capture greater value from AI. So I wanted to make note of that chart for you all. And then I wanted to also do the same on Qualcomm here. Qualcomm was downgraded at Bernstein to market perform from outperform. Target dropped aggressively from 175 to 140. Now, the interesting thing here is that the chart is a little different than it has been. Yes, we've made a new low. We have a new low in price just this week, but your RSI was aggressively oversold, and now it has bounced a little bit. This looks more like a bullish divergence. And one of the things to keep in mind is when we get negative news that is digested bullishly, that can be a turning point signal. Look to see if you get more in this way for Qualcomm. The stock has certainly undergone a healthy reversal. If we went to a 2-year chart, you can see, from our highs way back there to where we got to recently, it's been about a 45% drawdown. So, could this be a spot where a trader would look to expose themselves a little bit to the market in Qualcomm? Potentially, you might want to see some more validation, maybe back above the 20-day for the first time in a while would be a positive development on Qualcomm. So wanted to make sure I got you at least one upgrade and one downgrade in the discussion today, everybody. Thank you for being here. I appreciate you joining the segment. As we go forward, remember, we've got more to come here on the channel. I believe up next, we've got Connie Hill with verticals and diagonals. Make sure you're following Barb and me on X, Barb Armstrong CS, Kevin Horner CS, and do subscribe to the YouTube channel we call Trader Talks. Also, if you like this discussion for you today, please make sure that we are hitting that thumbs up button down below. We do get these reviewed into the archive for you, and that thumbs up helps us out on the replay. Let's take last 30 seconds. I'm going to bring back my futures chart and take a quick look. We've got a positive development as we wrap things up. VIX dropping, oil dropping, and S&P rallying a little bit. Let's see if we can continue to get the oil back lower. Oil back below 90 would be a positive development for the broad market today. We would like to see just that as I peruse what's been going on. I don't have any clarity or headlines as we close things out today to define why things are dropping just yet, but we'll take what we can get. Keep your eye on price action, everybody. Hopefully it aids you in making decisions along the way. So again, hope you all have a fantastic weekend. If you are in Denver for the event, stop by and say hi. I would love to see you there. Have a great weekend, everybody, and I will catch up with you again real soon.